Hello, this is Aaron Eitenbrook, advisor to Wall Street and the creator of VolumeAtPrice.com. Today I am going to share with you how to use volume at price information to be able to read any market that you choose to take a look at. And the 4 simple steps to using volume at price information is to first identify how the market is moving, secondly to identify extremes, 3 identify high volume areas, and 4 repeat these steps on multiple time frames. So to get us all on the same page, I just want to cover a few brief things and then we'll get right into the steps. So the first thing is what the market does. The market is facilitating transactions between buyers and sellers. It is merely a forum for buyers and sellers to come into a common marketplace to make a transaction. So it's facilitating the buyers, it's facilitating the sellers, and the price movements in that market are a reflection of the interactions between these buyers and sellers. And a first concept to understand is value. And value is something that the market defines. The market defines where current value is, and the movement of the market defines where the perceptions of value are between the buyers and sellers that are in that marketplace. The perceptions and intentions of the buyers in any marketplace, when somebody's buying, their perception is that value is higher or that value will be moving higher. And they're exercising or expressing that opinion by being on the buy side. Similarly, the sellers in a marketplace, they believe that value is lower or they believe that value will be moving lower, and their intention also is to make money or save money, and that expression is their participation on the sell side. So how the market moves. There's 2 different types of movements that the market makes. The first one is a directional move, and the direction can be up, the direction can be down, but when the market is moving persistently in one direction, that's classified as a directional move. The second type of movement is a rotational move, and that's also called a consolidation. It's when the market is moving sideways. It's oscillating back and forth. And when does this occur? These 2 types of market movements occur at all degrees of time. So when we look at a daily chart, you're going to see directional moves and you're going to see rotational moves. If you zoom that chart in, you are going to see directional moves and rotational moves inside of that chart that you just looked at. And this brings us to what is volume at price. Well, as the market trades, volume is being, transactions are being made. And a lot of times you've probably seen volume at the bottom of the chart, but volume at price is volume at a specific price level. It's a histogram that builds along the vertical scale. So each time volume is transacted at a certain price, it increments a histogram bar at that price level, and over time this histogram builds to show where the highest traded volume that has occurred and where there is very little volume, and it ends up looking like a histogram accumulation on the vertical scale of the chart. So let's take a look just real quickly at what this looks like, and then we'll get back into the 4 steps and I'll show you how to use them. So here we're looking at a simple bar chart. This is a bar chart, daily chart of the SPY, which is the S&P 500 tracking stock. So you can see along the bottom of the chart, this is volume. This shows how much volume was in each of these bars. What volume at price is it takes all of this volume, or it's tracking all of this volume, and rather than just accumulating the number of transactions, what it's doing is it's distributing each transaction on the vertical scale according to what price the transaction took place. So this is an e-signal tool that I'm using, and what you can see over this period of time, that's a volume at price histogram. And what that's showing is it's showing all the volume that's occurred over the period of time that I just applied that. It's taken all of this volume, and rather than just displaying the total transactions in each bar, it combines each transaction at a specific price, no matter how many bars it trades. So each time 210 trades, how much ever volume is traded each time at 210, it continues to accumulate in this red histogram. So that's volume at price. So let's get right into our 4 steps where we use this to read the market and read what the market is doing. The first thing that we want to do is we want to identify how the market is moving. And to identify how the market is moving, we can look at a few different time frames to get a sense of what we're looking at. So this is a weekly time frame. So you can see that the market is moving higher. It's in a big picture uptrend. If we look at the daily chart, you can see that we have recently been in a consolidation, and now potentially we are moving to the upside. Before this recent consolidation, we had another consolidation before that. So the extremes that we can see on this chart are, so now we've identified the extremes, and all we've basically done here is try to identify old highs and lows. And what we're most interested in is identifying in a phase of rotation, where are those extremes. And next, we want to identify high volume areas. So in applying a volume profile to identify the high volume areas, we're going to look at this last phase of rotation right here. And this is another rotational phase that we will take a look at. So we've captured these phases of rotation. We need to identify the high volume areas now that we've applied these profiles. And so now we have the high volume areas identified. This is all the information that we need to be able to formulate a read on what this market is doing. So we can see that the market is currently moving higher out of this most recent period of rotation. So if the market is moving into a new directional phase to the upside, then this old area of value, this old high volume area, should not be violated and should act as support if it's ever retested. This is a setup in using volume at price to create trading opportunities, or in creating trading opportunities. And you can see the same exercise if we were to just go back in time. You can see that the market had been trading rotationally and building volume in 2 different areas. Then the market pushed up out of this area, this zone of rotation. So this becomes support. It should not be violated. It's a potential buying opportunity on any revisit or retest. Well, you can see that the market did come back and test this area. It responded to the upside. It had another test, and it responded a second time to the upside, and the market has moved higher since then. We are in a similar situation now, where if the ongoing uptrend in the big picture is to continue, what should occur is the high volume area should act as support. Any retest to this old area of value should be rejected. It should be a buying opportunity, and that's the opportunity that this picture paints for us. So that was a look at the SPY, which is S&P 500. This chart that I'm showing you here is the TSX Composite. It's the Canadian stock market, and you can see that the same concepts apply. So if we just kind of step forward through time on this chart, you can see that the market had been oscillating back and forth, accumulating volume, and then once the market moved higher and had been moving above what was the extreme over the past several months, this high volume area was already established, and it was known that that is a potential area of support. The market traded at that breakout level, just below it, then above it, then at that level, then above it, and then it failed and came back below. However, on the retest to this high volume area, it held as support and it pushed it back to the upside. Now all the trading that happened around that breakout level had formed a smaller rotation up here. In the high volume area of that rotation on the initial reaction found resistance right there, and that was known at the time. It pushed it back down to test this large degree support. And this is the tug of war that in reading a market you can follow along and know where support is, where resistance is, and what kind of a bias that the market has. The retest to support held and moved up. It moved past this area and moved back to the upside to test what was at the extreme. The high volume area at the extreme was the higher resistance level. It tested this level and traded sideways, testing that level repeatedly before pulling back. On the pullback, it came back to test what was the most recent area of rotation, when it was tug of war back and forth between this small degree resistance and this large degree support. The volume that was built in that rotational phase provided support after the reaction from this big picture resistance zone, and that support level has held thus far. So in looking at this chart, we know where near-term support and resistance are on a smaller degree. We also know where, from a big degree, big picture perspective, where big picture support is and where big picture resistance is. And so depending on what your time frame is, when you're looking at any security, if you're looking for something on the very short term or whether you're looking for something on the long term, you can identify how the market is moving, look at where the extremes are, identify the high volume areas, and then repeat this on higher and lower time frames to identify where your areas of opportunity are to potentially get involved in a market, or conversely, if you're already involved in a market, you can adjust your positions or find targets and exits that are at high probability locations where the market is going to see a reaction. So I hope this was helpful. Feel free to send me a note or leave me a comment on the volumeatprice.com Facebook page. And until we talk again, happy investing.